The US Treasury market is flashing a warning signal. Not noise, not a short-term dislocation, a structural warning backed by data across three markets simultaneously. Here is what the data says. Five numbers, every one of them serious. 691 billion sold in US Treasuries in a single week. 5.2% the 30-year yield, highest since 2007. 18-year low, China's US Treasury holdings. $1 trillion Japanese-owned treasuries now at a risk of repatriation. 45% probability of a Fed rate hike in 2026. 1 month ago, that number was just 1%. Now it's 45%. The bond market is not flashing a warning, it is a screaming one. Look at this chart. The dashed line at 4%, that is where yields were before the Iran conflict began. Today, 10-year yield at 4.61%, 16th month high. 30-year yield at 5.20%, which is 18-year high. 70 basis points in weeks. The 10-year Treasury yield is the single most important interest rate in the world. Every mortgage, every corporate loan, every government borrowing cost globally is priced relative to it. When it comes to 70 basis points in weeks, everything reprices. Look at these four arrows. Mortgage, 30-year fixed now at 6.36%. Corporate borrowing, debt instantly more expensive. Hiring slows, investment slows, growth slows. Equities, higher discount rate compresses valuations. Emerging markets, taller debt becomes more expensive to service. Capital flees toward the higher US yields. Localized debt crises follow. One number at the center of this diagram is repricing every corner of the global economy. Why is this happening? Three shocks simultaneously. Shock 1, the inflation shock. Shock 2, the policy paralysis. Shock 3, the buyer's strike. Each one serious on its own. Together, a structural yield explosion. Every gauge on this slide is in the red zone. Energy, oil above $110 per barrel. Iran conflict, Strait of Hormuz effectively closed. Highest oil prices in 4 years. CPI 3.9%, up from 3.3%. Embedded in services, food and energy. This inflation is not resolving when the oil shocks end. It has already moved into the broader economy. ISM manufacturing prices 84.6, a 4-year high. Raw material costs surging at the fastest pace since 2022. Those costs follow through to the consumer prices in the months ahead. The result, negative real yields. T-bill yields are now below the rate of inflation. When you hold the US government debt and loses purchasing power in the real terms, you sell, and selling pushes yields higher. At the April 29 FOMC meeting, 4 officials dissented, the most since 1992. 3 voted against the easing bias, they want rate hikes on the table. 1 voted to cut immediately. The same committee, 3 want to hike, 1 wants to cut. This is not a divided committee. This is a fractured one. Kevin Warnes, new Fed chair as of the May 15th, inherits this chaos heading directly into Wednesday minutes release. Rate hike probability 45%. 1 month ago it was just 1%. JP Morgan's forecast, Fed hold all of 2026. Next move, a 25 basis point hike in quarterly 3, 2027. A fractured institution with no clear policy path in the middle of the yield spike is a bond market's worst nightmare. This is most underreported story in markets. Supply $691 billion in Treasuries sold in 1 week. The US must sell constantly to fund its deficit. Demand walking away. Japan $1 trillion in US Treasuries, the largest foreign holder on the planet. The Bank of Japan is hiking rates, Japanese bond yields at the highest since 1990s. The yen weakened past 160. Japanese capital is going home, not staying in the US. China holding at an 18-year low, a systematic, deliberate multi-year reduction in the US debt exposure. The Iran conflict has only accelerated it. The collateral damaged. Foreign investor lost 142.1 billion in valuation losses on US Treasuries in March alone. When you lose 142 billion in 1 month holding something, you sell it. Supply exploding, demand collapsing. That is a yield explosion. 1994 versus 2026. The last time the bond market behaved like this was 1994, the Great Bond Massacre. In 7 months, bondholders lost over $1 trillion. 30-year yield surged from 6.2 to above 8%. Mortgage rates rose more than 30%. Orange country, California went bankrupt. Look at the comparison. 1994, economy expanding, Fed in full control, foreign demand stable, normal issuance levels. 2026, stagflation and geopolitical shock, Fed fractured, foreign buyers retreating, $691 billion sold in just 1 week. The bottom line on this slide, 1994, the Fed was in control. In 2026, the Fed is fighting an external shock it cannot control. In 1994, the Fed caused the sell-off. The Fed could end it. In 2026, the sell-off is being driven by an oil shock, foreign capital flight, and a structural fiscal crisis. None of those responded to the rate decision. This is why this is a structural, not a cyclical. The US runs a permanent deficit. To fund it, it issues bonds constantly. To supply pushes yields higher. Higher yields makes the next refinancing more expensive. More expensive debt widens the deficit. The wider deficit requires more bond, and the more bond pushes yields higher again. The proof is in this week's auction. $52 billion in 10-year notes sold at 4.468%. They replaced $28 billion of notes from May 2016 that yield at 1.710%. The cost to service that specific debt nearly doubled. This spiral does not stop on its own. When correlations break. Here is the signal that matters most. Three markets, three simultaneous anomalies, yield surging to 18-year highs, the dollar weakening anomaly, rising yields normally attract the foreign capital and strengthen the dollar. That is not happening. Gold, rising alongside yields anomaly. Gold normally falls when the real yields rise. That is also not happening. Both correlation is broken. And at the same time, read at the bottom of this slide. The fact that the dollar is weakening and gold is rising alongside surging yields proves this is not an inflation trade. Foreign investors are leaving US assets entirely, and the market is pricing in a fiscal spiral and a sovereign loss of confidence. Sovereign loss of confidence. That is what broken correlations tell you when they all break in the same direction at the same time. Portfolio triage. What this means for your portfolio directly. Equities, volatile and compressing. Higher yields equal higher discount rates. Growth stocks and AI tech valuations are being squeezed in the real time. Gold, rising, breaking its correlation, acting as a hedge against sovereign dollar debasement. Not a normal inflation trade. When gold ignores the headwinds that should push it down, pay attention. The dollar weakening. Capital is not rotating within the US system, it is leaving it entirely. Real estate frozen. Mortgage rate at 6.36%. Any further spike could toward lead to 7%. Paralyzes the housing liquidity completely. The New York Fed Recession Probability Model. The Macroeconomic Prognosis. The New York Fed Recession Probability Model. Current reading above 30%. 30% is the caution threshold. Historically, above 50% meant recession was the base case within 12 months. We are above 30, rising. The 40-year bond bull markets that ended in the mid-2020 at 0.5% is officially over. Yields have risen tenfold since at the bottom. The repricing is not done yet. The big picture. When the bond market and the currency market and the equity market all send the same warning signal at the same time, this is not a noise, this is a signal. And this is a serious signal. Three concurrent shocks. The broken data spiral, foreign buyers walking away, correlation breaking across three markets, a fractured central bank. These are not separate stories, they are just a one story. The markets are telling you something. They have been right about these things far more often than the commentary has. Subscribe every Tuesday and Friday. Market Thesis publishes a macro thesis like this one.